Hi, everyone. Welcome to our show for March 2nd, 2015. My name is David Kosmeter. I'm the creator of Timing Research, and this show we will be discussing the 75th weekly report for Timing Research. If you haven't had a chance to take a look at this report yet, just go to TimingResearch.com/reports, and you can download it there. And I have Dave Landry again, guest hosting for me, so I'm going to turn over the show to him.
Thank you, Dave Kosmeter, and thank you to Timing Research for once again having me back to host the show. Looks like we got a pretty good lineup today. I think everybody here has been here before, with maybe one exception. Let's see. First of all, let me introduce everyone. We have AJ Brown of TradingTrader.com. We have Bennett McDowell of TradersCoach.com, and Glenn Thompson of PacificTradingAcademy.com. AJ, let's go to you first. Tell us a little bit about yourself, a little bit about your trading, and a little bit about TradingTrainer.com.
Thanks for having me on here, by the way.
Thanks for being here.
This is AJ, and I've been working with TradingTrainer.com. I actually founded that in 2003. We focus on equity options, and we have kind of a unique way of going about the learning process. We do a learn while you earn kind of immersion process versus selling out, trying to get people to use home study courses and things like that. And the kind of fun part about what we're doing is we have a sister nonprofit that teaches inner city kids up in Chicago how to do trading and take care of their money and work on accumulation versus debt. And all of our profits go towards that nonprofit. So it's kind of a fun little combination that we've got going on. I've been trading since '97. Trading Trainer was founded in 2003. And yeah, always having a ball. Thanks for having me here.
Cool. Thanks for being here. Okay, next up we have Glenn Thompson of PacificTradingAcademy.com. Glenn, tell us a little bit more about yourself and tell us a little bit about your trading and PacificTradingAcademy.com. Easy for me to say.
Sure. Again, I echo the sentiment. Thanks for having me, guys. Once again, it's a pleasure, as always. I've been trading since, I guess, early 80s. I've worked with PTA, Pacific Trading Academy, for going on 14 plus years now, and I work as a mentor in that and consult in that capacity. And during the process of my teaching, I've taught all types of traders of all levels, beginners to experts, and all levels in between. In my own trading, the approach I take is primarily technical, and that's a big excursion away from what I did when I began and more than 30 years ago. But I've limited my own trading pretty much right now in the last few years to primarily the equity indices, or primarily the S&P, and I do forex trading as well. That's how I earn most of my living. But I've done pretty much all types of trading, options, short-term, long-term. So it's a joy for me, and the educational component that I involve myself with at PTA kind of is an overlap or an extension of my own trading. So it's a passion of mine.
Cool.
So happy to be here.
Cool. Glad to have you. To those of you who don't know me, my name is Dave Landry. Well, first let's see. That was Glenn. I'm sorry, Bennett. Let me get the lineup is mixed today, so mixed up. So let me get to you first. We have Bennett McDowell of TradersCoach.com. Tell us a little bit more, or tell us about yourself, Bennett, and then tell us a little bit more about TradersCoach.com.
Yeah, hi Dave, and hi everybody. I'll be glad to. Basically, we formed TradersCoach.com back in 1998. I've been trading for a little over 25 plus years. And we focus primarily on technical analysis. We do at times use some fundamental analysis to steer us in the right sectors or directions of the market, but our focus is technical analysis and some proprietary software that I developed over the years that focus on really price patterns, price activity. We do take a look at momentum in certain times in the markets, but we focus primarily on technical analysis. And we do a lot of coaching of students around the world. Our software is now used in over 65 countries worldwide. So we have a pretty big following Forex, a lot of traders that trade the S&P, as well as position trading futures and stocks.
Cool, good stuff. Yeah, sorry about the order. Sometimes I'm lucky and everybody logs in the order that they're on the list, and sometimes they get mixed up. So, but I got it straight now. My name is Dave Landry. For those of you who don't know me, my website's DaveLandry.com. I've been at this for over 20 years. I spent time on both the retail side and on the institutional side. I was a CTA for about 15 years or so. I've gravitated towards stocks over the last probably 15, 16 years. I think there's an inefficiency in stocks that doesn't occur as often in a lot of these other markets. I will trade some of these other markets, such as Forex and indices, etc., but I prefer stocks. And my basic methodology is mostly pullback related. I think you can only predict the short term when it comes to markets, but through proper money management, you can stay with positions longer term. And I don't want to talk too much about myself, but I have a 21-page report for anyone who may be interested. Just shoot me an email at dave@davelandry.com. I'll give you the basics of the methodology. The rest is just details. Okay, AJ, let's go to you with question number 2. Based on any technical fundamental indicators you want to use, would you predict that the S&P index will move higher or lower this week? And that's going to be the close, obviously, Friday the 6th, from where we are now to the close of Friday the 6th.
So we're actually just, for my team, we're actually just watching it. We've been watching it for 3 weeks, backed up against this level of resistance in a form of range contraction. We're watching carefully how investors react. This is the first week of the month, and so that means there's a whole bunch of things on the economic calendar, especially employment at the end of the week, which a lot of people like to wait for. We've got our beige book on Wednesday, which a lot of people sometimes react to, meaning the market movers out there. But from a technical perspective, we've been seeing that we are bumped up against resistance. We've got hints on our side from some of our indicators that we could be changing personality and moving into an uptrend. We also have hints that we could be continuing to go sideways. So what we're trading in the options world is we're looking for strategies that profit whether the market goes sideways or up.
Okay. So what would your prediction be, up or down between now and Friday?
I still say sideways.
Well, we gotta nail you down. Well, just pick one and just give us a low confidence, and then we'll.
I think that the S&P, if anything, is going to go up.
Okay, and based on that, rate your confidence in that answer of going up on a scale of 0 to 65%. All right, 6.5. All right. Okay, let's go to you, Glenn. Based on any technical or fundamental indicators you want to use, would you predict that the S&P index will move higher or lower this week? And that's the close of March 6th. And then once you give us that prediction, go ahead on the scale of 0 to 10, with 0 being no confidence and 10 being extremely confident. Rate your answer.
Sure. My answer is I expect at the close on Friday the S&P to be lower than where we are at right now. When I considered so that's my answer, and I would give it about an 8 on a 1 to 10 scale. I wish I'm not I wouldn't be a good politician, because my answer that I'd like to give would be what AJ just said, sideways, because of the uncertainty. And curiously enough, we do this questionnaire on a Monday. Here's the detail of what gets me to my answer. I have a cycle, or a confluence of cycles, coming in this Wednesday that indicate a turn in the market. So my answer really is dependent on what's going to happen between now and then. If we're trending lower into Wednesday, then I'd be expecting a higher close at the end of the week. On the other hand, if we move higher, which I expect we will between now and the mid part of the week, I expect a top to form. All of the factors that AJ and all the fundamental and technicals, I think, result are the underlying factors that are ultimately discounted by time, and that's kind of my area of research. Not to suggest that I'm going to construct a strategy based on a time relationship solely, but I start there. So yeah, we've got all the fundamental events that are scheduled for this week. We've got, what is it, U.S. non-farm payroll on Friday. We've got an ECB meeting report on Thursday to indicate, I think this is the first month where we're going to have the buying program over in Europe begin. My point is this: if it weren't those specific events, it would be something else. But ultimately, whatever happens fundamentally, and that ultimately initially is felt or seen in the price, is a direct consequence or indirect consequence of certain specific amounts of time. I've got a confluence of cycles again that come in this Wednesday. The correlation track record is about 92% of the time we see the market exhibit sensitivity to this, and as such I expect a turning point. My confidence number of 8 is based on what I'm seeing this morning, and therefore I'm expecting the market to rise between now and, say, Wednesday at the end of the session, and that would mean lower prices by the end of the week. So that's my answer.
Okay. I just got back from Europe, and the feeling over there and then the feeling over here in this show over the last several weeks is that they're going to take a page out of the book of the United States when it comes to this quantitative easing, easy for me to say, and they're going to use a bazooka, if anything, kind of like we did. Okay, Bennett, you're up next. Based on any technical or fundamental indicators you want to use, would you predict that the S&P 500 index will move higher or lower by the end of this week? And that's a close, obviously, of March 6th. And then after you give us your answer, go ahead and rate that on a scale of 0 to 10, with 0 being no confidence and 10 being extremely confidence.
I love the bazooka. I love the bazooka comment. That's a great one.
I stole that from somebody on the show, and I wish I could remember who said it, but I thought it was great.
Yeah, that's a good one. All right. Well, for this, what I do is I use the 60-minute chart of the S&P E-mini, and this usually gives me a pretty good idea of where the market's going from more of a short-term basis. Based on this, you know, we had a nice wedge that the market broke out of in early February. Since then, it's taken off, which is what you'd expect, you know, out of that type of pattern. And now we've hit a Fibonacci resistance level and also an Elliott Wave 5 at the top. We backed off a little bit. Yeah, we're seeing some positive movement today, but there's a support level I'm watching, which is the February 20th support level at 2082.25 on the 60-minute chart. If that gets broken, I would expect some selling to come down, and you know, we've been in a little bit of an uptrend on the Dow since February 2nd, so we'll probably fill some of that movement to the upside. So to answer your question, I expect the S&P to be down by Friday, and I'd say probably about an 80% accuracy level on that, just based on Elliott Wave and Fib levels being met, and it would even go higher once that support level is broken, but so far it has not been broken yet.
Okay. I'm been slotted. I'm a trend follower. And then in the late 90s, in 1999, I received an email from someone who was obviously heavily short the market and losing their butt, and they called me a trend-following moron. And since then, the name is stuck, and I bought the domain, and I've had T-shirts made and buttons made, and I kind of took it and rolled with it, and I have a lot of fun with it. But one thing it forces me to do, it's a constant reminder that I shouldn't try to outsmart the market by using some sort of complex or arcane techniques. It's not my way or highway. A lot of other people like to do those things, and I find some of them quite interesting, but I prefer to just kind of look at the charts and try to err on the side of which way or the market is headed based on recent highs and whether or not I can draw an up arrow. In fact, I even have a marquee arrow that I use to help me find market direction. I think I've showed it on the show before. If we get it on, there we go. So, you know, so far the arrow is still pointing up. I'm gonna stick with that. Not try to outsmart the market. So, on these shows, as long as the market can remain at or near new highs, I'm gonna go ahead and err on the side of it going higher. I am 100% technical trader. One thing I like about the S&P, and I really like even more about the Nasdaq 100. I mean, sorry, the Nasdaq itself, In the S&Ps, you have a bit of a persistent move higher from the bottom of the base, which is around 1975, up to where we are now. We've had a little bit of a breakout. I'd feel a lot better if the market would accelerate out of this breakout. But so far, so good. As long as we stay up around 2100, I'm not going to turn bearish. And if you take a look at the NASDAQ, not to get sidetracked, but if you take a look at the NASDAQ, we've had a really nice persistent uptrend. We had a really nice breakout in the NASDAQ, so that's looking pretty good. So that's really nice. I'd like to see the S&P and the Russell 2000 basis, the IWM, follow suit. But you can't have everything, I guess. And if you did, where would you put it? So let's go. I'm going to go with up because I'm going to err on the side of the trend, and then I'm going to give that a confidence of about 7. And the only other thing I want to say is you just mentioned the Bennett just mentioned the 60-minute chart. I'm not a big fan of intraday charts, but I will say this: if a market is going to turn, it's going to turn on the 60-minute before it'll turn on the daily. And one thing I like to watch for, especially coming off of all-time highs, I'm not so worried about it if we're just bouncing around in a range, but if you take a look at the S&P 500, like the spiders is what I look at for this research, if you get a bow tie down, which is a moving average crossing of a 10 simple, 20 exponential, and 30 exponential, after the market makes an all-time high in the 60-minute chart, a lot of time you could have a significant top. So I'm glad you brought that up, Bennett. It's something that I don't look at that often, but since you mentioned it, I'm going to keep an eye on that 60-minute chart as long as the S&P is at or near these new highs and see if we get a turn there first. And I think that could be a warning signal. So, again, I'm going to go up with a confidence of about 7 on that. Okay, let's go to the next question here. And what developing events, and this is going to go to you, AJ, back to you. What developing events, and they can be technical or fundamental, will you be watching out for this week, and this is obviously between now and Friday, that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Fantastic. So I'm specifically looking at that level of resistance overhead, and I'm also watching that the VIX has gotten below the 200 moving average on the VIX, meaning that people are a little bit
complacent?
Yes. And those are my 2 iffy points. And I'm very much also seeing a confluence on Wednesday, maybe reaching into Thursday, of a bunch of our different indications. And so the only other thing that I think I call it a transient external stochastic shock, and I agree that they come and go, but I think specifically for this week, people do like to hold off and then come all in on Friday based on employment. And so I think that along with the European Central Bank piece, will cause some interesting times for people who are trading intraday.
Cool. I like the, as I say each week, and this is why I love doing these shows and keep coming back, is I always learn something, and I never really thought about looking at the 200-day of the VIX, and I would just pulled it up, and right around the December top, we dipped below that. That's the last time we dipped below that 200-day moving average. So that might be something that's worth keeping an eye on. So I'm definitely going to make some notes on that. So thanks for bringing that to our attention there, AJ. Good stuff.
It's a little mean reversion.
Yeah. Good stuff. I did a lot of VIX research many years ago, and every now and then it's kind of cool to be reminded that something that you might want to take a look at again. All right, Glenn, you're up next. What developing events, they can be technical or fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Sure. Well, one of the 2 I mentioned earlier, at the end of the week, the non-farm payroll data that comes out, I think, on Friday, ECB, I think, on Thursday, and I think I'll be watching one of the other events that occurred last week, the rate cut in China, to what extent the market is sensitive to that on the fundamental front. And again, I'm not a fundamentalist, but in consideration, they may be the particular catalyst or events that the market is sensitive to during the next few sessions. More than typical, from a more technical examination, I would be paying a particular attention this week at sentiment indicators. Overbought, oversold, whatever generic oscillator one might look to, or just anything that's going to give an indication of sentiment. The first thing I looked at this morning was just generally going over the news, the degree of pessimism that's out there concerning just the world, money flowing, capital flows out of, to the United States as being a causative agent for bidding the dollar price up. And my thought is, to the extent there's any negative or collective view about stocks reaching or getting close to a top, I curiously, in a contrarian way, look at it as a positive for the stock market. And I wanted to, I'm bearish only within this short window of this week. And I agree with you, Dave, what you said. I'm still bullish the stock market. If we were doing this interview next Monday, I would tell you that I expect next Friday's close in the S&P to be higher. So call me moronic. I'd rather I'd rather track the market and follow. So I am a trend follower when all is said and done at the end of the day. I just think in particular this week I've got a particular cycle that is going to create by the end of this week a pullback in equities. And so my strategic idea would be to buy pullbacks. And I think by the end of the week into the first part of next week will be a good opportunity to go long equities in the U.S. So I am not suggesting that the bull market, generically speaking, is over here in this country. I think to the extent we continue to have global deflation, we're going to see. I haven't given up on the effectiveness of the world central bankers. I'm not saying, as I think an economist at SocGen made the comment earlier today, that the world is assuming complete omnipotence on the part of the central bankers, especially the U.S. Fed. I don't go that far, but I think as long as we can, what's the cliche, push that can down the road further, there's more. The smart money is still to the upside, and the reason I'm really comfortable in that assertion is because there is a resident amount of bearishness out there. People are getting concerned. If it weren't for that, I would be very intrinsically concerned that we are near a top of a generic bull. But yeah. I similarly to you, Dave, I am bullish. I just think for this current week, watch the sentiment. As long as there's a residue of bearishness out there, I think the market has more room to the upside. But I think we're going to have a pullback into this week, and I'll be looking at maybe by the end of the week or into the first part of next week, between now and next Wednesday, to be looking for opportunities to go long the equities. Yeah.
Yeah.
So I'd be again. The synopsis is I'd be looking at an RSI or anything that's going to show an extreme overbought condition to indicate that maybe there's a lack of counterparties to take the positions, and so that's the key technical factor I'd look at.
Yeah, I don't want to speak out of turn. I just want to comment on a couple things you said. The number one, the deflation. I just got back from Italy, and I saw that firsthand. One of my friends over there, we were riding around, and we rode by one of his rent houses. We had to check out that he had on the market, and he was telling me that he's been trying to sell it for several years, and each month he drops it by about $10,000 and just trying to see if he could find that price discovery with his house. And I thought that was kind of interesting. The other thing I like what you said is the wall of worry, and one advantage that I have, and I'm assuming you guys see the same thing, with the educational business, you get to interact with a lot of people, and you get a good feel for that sentiment. And it seems like any time the market has a little bit of a downtick, I get a dozen emails telling me that it's the end of the world, and I guess predict early and often. But I'm amazed at how much bearishness comes out on each little downtick. So I don't know. I think it's a good thing. But before I speak too much, let's go over you, Bennett, and let us know what developing events, they can be technical, fundamental, would you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets.
Sure, Dave. I kind of agree with Glenn. I think basically if you ask me this question next week, I would be more bullish than I would be this week. I think also, too, again, like I had mentioned before, I'm watching that February 20th low on the S&P E-mini 60-minute time frame, which is 2,082.25. I think if that gets broken, we'll probably see 2 to 4, maybe 2 to 5 days of bearish activity, which would be only a minor pullback in the Dow, but one that would pull it back maybe to 17,750, maybe 18 in that range there. And then I can think we'd see a resumption of the uptrend. So I don't think the uptrend's over. In fact, if you look at the weekly chart on the Dow, the price activity, which is a real reality of the market, is just up. I mean, the trend is up. If you talk about being a trend follower, if you look at that chart, it is up, all right? Now, we may be seeing bearish divergence in some of the indicators we all look at, like the histograms, but the reality is it hasn't broken yet. It is up. So I am looking for long trades primarily. I think any pullback we see at this point is an opportunity right now to buy. One day will be wrong, okay, and that's where our risk control will save the day. But for right now, you have to go with the numbers, and the numbers from a reality standpoint is that the trend is up. So I do think, again, I'm looking short term for this week at that 60-minute time frame. Just that support level is an important level that I watch. Long term, I look at the longer term charts like the daily and the weekly of the Dow, and so far those are indicating an uptrend. And really all of 2015 in terms of the daily chart has been actually a tough market to make money from a position trading standpoint, because if you go back to the start of 2015, it's been channeling until recently when it started breaking above its 2014 high. So I think maybe now we may actually see a trend in that market, and our long position trades should yield a pretty good profit. But again, if it goes back into a channel, that won't be the case.
Yeah.
So, the trend is up in terms of the weekly charts. It's just been a tough year so far.
Yeah, I mean that's one of the yeah, I agree. As far as the range-bound trading, it's really tough to you can't catch a tan when there's no sun, and you can't catch a trend when there's none. The thing about trends is they do go a lot. Well, before I get into that, one thought I wanted to say was that's one of the complaints about the show is we don't have enough controversy. So I agree with pretty much agree with all of you guys. Nice analysis. I was at the American Association of Professional Technical Analysts meeting about a year ago, last March, right around this time, and one of our guest speakers was Ed Sakota, and he came in and talked about bubbles, and it was a very fascinating speech and carefully thought, and a lot of economics and government issues and things that all kind of come together for his reasoning. But he thinks we'll see reoccurring bubbles throughout asset classes. And I think that's going to be good for the trend follower. Bubbles are wonderful. I did a column a couple of weeks back just on that, and that they last a lot longer and go a lot further than most people are willing to admit. And that's the same thing I used to say about trends. And Bennett, you just alluded to that, about the trends lasting longer and going much further. And that's it. They seem to exist as long as people fight them. A couple things that are going on in the market. I am a technician, and a pure technician. I don't worry about any news. And I'm going to get an email tonight, tomorrow, the next day. What about earnings? No, don't worry about it. What about the situation in Nigeria? No, don't worry about it. So it's always something to worry about, but I don't worry about it. And then, as we said a few minutes ago, the market has been climbing that wall of worries. So far, so good. S&P 500 has broken out. Not as decisive, again, as I would prefer, but so far, so good. NASDAQ has broken out. Nice persistent trend. Persistency is mathematically equivalent to, easy for me to say, linear regression, and it's a very powerful concept. Just draw a trend line through the bars or draw a linear regression line through them, and you can see that it's a very solid breakout, and there's consistent buying coming in. Obviously, there's always something to worry about. The rates have had a big drop. Bonds have had a big drop. Rates had a big increase. I don't know if that's going to tap the brakes on the market, but it's something worth watching. Transports are kind of just stuck in a range, kind of like the S&P was forever. I don't really worry too much about the transports following through, but it doesn't hurt. The more confirmation, the better. Right now, we're getting plenty of confirmation in the semiconductors and hardware and software and defense and a lot of these tech areas, and some of these non-tech areas like retail doing fairly well too. So far, so good. Trend is up. I am bullish on the commodities in here, especially oil and gas, and my reasoning lately in layman's terms has been, have you filled your car up lately? So I think we bottomed out there. Unfortunately, with these commodities, it's a bit of a process more than an event. It's a more efficient market, a little bit more difficult to trade. We're long USO, we're long DNR, and so far those positions really haven't worked out great just yet. We're also long some gold in here. I think gold has bottomed out, but again, process more than an event. And the only other thing to kind of close things up on this is that the rare earths have caught my eye lately. The only problem with those stocks is they've been really beat up, and they're very volatile, and they're also low price. So tread lightly if you do take some positions there. And also, you might want to make sure you wait for an entry. In other words, wait for them to start rallying off their lows before looking to get long. Okay, long-winded answer saying things are okay so far. AJ, let's go back to you for the open-ended question of the week. And the question is, if you could go back in time and give your 20-year-old self some financial advice, what would it be?
I actually I just got back from spending 4 months in Sardinia, which is an island in the Mediterranean, also part of Italy. I purchased a house there that I'm now going to be living in half the year.
Cool.
And yeah, one of the things that happened, though, of course, because I don't speak a lick of Italian, or at least I didn't, is they don't speak any English.
See.
And one of the things that I learned very quickly there is that going to learn something like a new language is going from like consciously being incompetent about it to being consciously competent, and then through repetition becoming unconsciously competent at it. And it made me think for the 4 months, especially the first month where I was drinking from a fire hose of the Italian, what it felt like in 1997 when I started to trade options. And I think I could have sped up that process, and I actually was 20 earlier than that, but I think I could have sped up that process if I would have gotten with some other traders, either at my level or above, and had them look over my shoulder, make sure I wasn't going to be trading signals that I was making up in my mind, not seeing, but also just holding me accountable and also making sure that my mind game was correct, because there were so many people telling me that I was doing things, getting into things that was too risky for me. And it was every time I had a losing trade, which is natural, you're going to have losing trades, those voices would appear in the back of my head and almost doom me to do the next trade. So getting into, and that's how I actually learned Italian. I actually had to get into a group of people who were also learning Italian. Maybe they were a step ahead of me, and we just got to do it together. And they held me accountable, making sure I woke up every day and attacked it again. And that's what I would have done again. It told my 20-year-old self, hey, don't try to go this alone. Get into a group of other traders so that they can check your work and keep you accountable and give you support.
Yeah, amen. I agree on that. I've been working on the Italian too for a while, and I'm getting it. I'm to a point where I know when they're talking about me, and I catch about every third word.
Absolutely.
Pretty good idea. But they talk really fast. I'll do like a little intro to my speech and speak a few words and maybe even a whole sentence here and there. But I know not to get too far away from the translator.
Just talk with your hand.
Well, we might have to come visit you in Sardinia next time we're over there. That looks like a neat little place.
Cagliari is the place to be. But answer I found is just keep talking with your hands.
Amen. You watch them. It's scary if you watch them drive and they're talking on the cell phone. They drive great over there. I'm not picking on them, but it's like one hand's in the air, the other hand's on the cell phone, and it's like, how are they steering through this traffic? Especially these little roundabouts and all. But anyway, good answer on that. Okay, Glenn, let's go to you. If you could go back in time and give your 20-year-old self some financial advice, what would it be?
Right. I kind of, when I saw the question, some of the possible answers that David had sent me were save and invest in growth, take take a lot of small losses, I think, is universally a truism that I probably knew back then but didn't really know and live and wasn't immersed in. So I think I would reiterate and kind of emphasize that. And to AJ's point, I hadn't thought of that, but the importance of kind of immersing yourself in a group, or one way or other establishing a relationship with someone who's been there and done it, so that they can give you the immediacy of feedback and force your hand, as it will, to hold you accountable. And I think that is critical. When I first started, I was 24 and didn't really have a formal teaching or coaching or mentoring relationship, and I think that so I did the next best thing. I reached out in very inefficient ways to anyone and everyone I could to try and get that feedback, to guide, to ensure that if I got off the correct track, I was brought back on, kind of as a figurative tether. So I like AJ's response, and establishing some type of relationship that's going to ensure you're on the right track in this business. And for me personally, I have, before I was 20 and when I was 20 and even through to this day, in every aspect of my life, and even in this specified realm of investing and trading, patience, or in my case, lack thereof. So just reiterating and forcing myself to be patient. I would say my biggest mistake as a speculator in the process of trading is I tend to want to pull the trigger. That phenomena, if I don't, my mind will see things maybe that aren't really there because I'm concerned about the possibility of missing an opportunity. So I have a tendency to pull the trigger before, in an objective sense, all the criteria that I know intellectually or should be present are actually present. And so I need, constantly to put myself, and would have more so at 20 years old, that patience as a specific protocol to pay attention to.
Yeah, amen. Intuition versus intuition there.
Sure. And then, one final thing I forgot, just
go
on a practical thing, to be not only to be facetious, but point of fact. Yeah, I would have bought Microsoft, Apple, and Caterpillar. I would have never conceived, at 20 years old, it would have been truly prescient on my part. I would have been Oracle of Glenn had I thought to short Kodak. I grew up with Kodak and never would have assumed. My uncle lived in Rochester, New York, and sent my father when I was like 10 years old shares of Kodak that my dad held in custody for me. So I would have never conceived that Kodak would have been where they are now. But yeah, obviously that too.
Yeah, of course. Good stuff, and I have some more some things to kind of dovetail in with both of you guys, because good answers on those. But before we do that, let's go over to you, Bennett. If you can go back in time and give your 20-year-old self some financial advice, what would it be?
Well, I love Glenn's answer about Apple and all those stocks. I have one, Starbucks. Yeah. I remember I was living in New York at the time. We always bought our coffee at the deli. And what did we pay? 25 cents at the most? And it was great. And then Starbucks comes out where they're charging like 75 cents for a cup of coffee. I thought that was the craziest thing I'd ever heard.
Holy crap, you're showing your age, man.
Yeah, I know. I don't want to do that, but it's true.
Go to Starbucks for 75 cents and try to get some coffee.
Yeah, right. But yeah, that was a triple the price. Who would pay for that? And who wants to hang out at a coffee place, talking and treating it like a bar? You went to a real bar.
Yeah,
So it's kind of a funny thing. All right, more seriously though, when I started trading, there just, the internet was really not evolved like it is now. There was not a lot of information out there except for what you could get at the bookstore. But you walked into the bookstore and there were like 100 books on trading and investing. So you didn't really know, unless you were on the inside, what techniques really worked. So I think in the beginning it would have been really helpful for me if I could have had a mentor early on that could have maybe steered me down the right path instead of going down to the wrong path and then change paths and start over. And back then too, you really risk control was not at the forefront of a lot of the thinking like it is today. So you had to learn that. A lot of these things you had to learn by experience. You didn't really think about having a simulated account like you would today. The brokers really didn't offer it back then, and so you kind of got into the markets and if you were wrong, you lost money. And so you kind of paid your tuition that way in the very, very beginning. So I think, you know, if I could have done it over again, I think I would have gotten to a mentor a lot sooner. I eventually did, but I think it would have saved me a lot of money and a lot of time. But, you know, listen, we're all product of where we ended up, and sometimes we learn the most from our mistakes.
Absolutely.
So, you know, you got to look at it that way.
Yeah, good stuff. I mean, I agree with everyone. As AJ started the conversation with, it's okay to lose, and both Glenn and Bennett kind of dovetailed in on that and seemed to agree. I'm glad you brought that up, because that's something that early on, if you lost in a trade early on, you thought, wow, what the heck is wrong with me, and something's wrong, and then it kind of shakes your confidence. And then, of course, the next trade that comes along, you don't take because your confidence has been shaking. There's so many things. I could talk for hours on this. I just want to touch upon a few things. Based on what you just said, you guys just said on okay to lose, the psychology of that is psychology is vitally important, and the trading world is completely different from the real world, and you kind of have to unlearn quite a few things. And then both of you guys touched upon patience, or all three of you, I should say. And patience is vitally important, and sometimes you just have to wait. And if you're a doctor or a lawyer or automatic transmission mechanic, you better fix some transmissions, or you better get some clients. You better do something. But in trading, sometimes you just need to sit on your butt. I agree with all three of you guys on finding someone to mentor you, to kind of take the steepness out of the yield curve. In fact, everything that I do on my website, or when I write, or if it's a book or whatever the case may be, or a webinar, I try to do it talking back to that 20-something year-old Dave from many years back. So hopefully there's someone that age that's hearing me, and it strikes a chord with them. So it can really take the steepness out of the learning curve. I was lucky. I hooked up with a bunch of old school guys, a bunch of successful traders. By a complete accident, I had read an article on some mechanical testing that I was doing, which I actually no longer do, and that kind of launched my career. And I ended up in a hedge fund and with some other guys, and they started a retail website, and so that's how by accident I ended up in the education business, and I absolutely love it. And one reason I love it is because it forces me to stay sharp, and I've learned that just to keep things simple. One thing, just a couple things, is that I've been telling a guy recently who has a lot of issues. He overtrades quite a bit, but I was trying to explain to him that if you trade properly, it's almost to a point where it's boring. And I think a lot of people get in this business because of the excitement, and maybe some of us guys on the educational side are guilty for that. I would tell that guy, 20-something-year-old Dave, that you know, you don't have to know every pattern in the world. You don't have to know every system in the world. One time when I was doing a lot of system programming, and this was kind of typical rinse and repeat every day, I'd go home and tell my wife about this great system, and she would patiently listen to the statistics, and I know she could care less, but she would listen to me. And then one day she said, well, how many systems do you really need? And it just kind of hit me like a ton of bricks. You only need one, and we all go through this grail hunt where we try to find this perfect system. And the best day of my career is probably also in a bit of a bittersweet, because I realized that there is no holy grail. And you'd be surprised at how we tend to make things more and more complex, thinking that we're looking for that complex holy grail solution. And the true enlightenment, at least for me, came when I started peeling those indicators off to a point where I could actually see the price chart again. And other than the occasional moving averages, like I mentioned earlier, that's all I use. So to wrap this up, I would pick one pattern and get good at it. I'm always preaching to people, persistent pullbacks is the way to go. Persistency, again, is just a market that goes up day after day after day after day. Look to play a pullback. That one pattern would have kept you from going long the entire year of 2008. I went through every stock of the year, and I personally couldn't find any long side setups based on that. So just that one pattern, you'd beaten 95% of all money managers. If you're not successful with one pattern, you're not going to be successful with 10. So find something really simple, stick with it, and then all of you guys, I wanted to give you each one credit, but I think you all mentioned equally, patience is important. And, you know, learn how to lose a little bit too. It's okay to lose. As long as you did the right thing, it's okay to lose in a trade. You almost have to reward yourself for whether you did the right thing or not versus whether you made money or not. And again, that's a little counterintuitive. But just keep it simple. That's kind of a long-winded answer. I have a lot to say to that guy back there. So again, I could probably go on and on. Okay, let's go back to you, AJ. Anything else you want to tell us about your trading style? And also, anything else you want to tell us about TimingResearch.com?
It's funny that the one thing that when you were talking, you said the real world and the trading world, and I think sometimes I get that flip-flopped. But I always ask folks that I'm working with to think about what is their main outcome. You know, when I actually got to the point in 2005 where I was able to ditch my day job, and that was working for Hewlett-Packard as a high-end executive marketer in Silicon Valley, and that was the best thing. And I wanted to have time freedom, and the last thing I wanted to do was exactly what you said: overtrade, sit in front of the computer all day, and create another job for myself. And so I actually recommend, and this is what I did, is setting an egg timer and keeping it real, keeping it down to like 30 or 40 minutes of analysis in the night, not staying up until 2 a.m. looking at charts and missing time with your family, missing time with whoever it is that is important to you, because you have to create something sustainable. When I mentioned earlier about the unconscious competence, I mean, you don't think about driving a car anymore. You don't think about brushing your teeth. You know, you want to be able to do this for the long term, especially if, you know, you're using this in order to build up a retirement package and you're a little bit late to the game or something like that. Just stay very focused on why you got into it and don't get wowed by the bells and whistles. I agree with you wholeheartedly about that. And, you know, looking at naked charts and all that. One of the things that attracted me to equity option trading is it's just a game of pattern recognition and then pattern utilization. You recognize what patterns the markets are throwing at you, and then thanks to the flexibility of options, you've got all these different combinations. It's like going to a toolbox and matching whatever you see with whatever's going to profit from it. I actually am stoked about the sideways choppy market because with my option strategies, I've been profiting left and right since the beginning of the year. And so we're actually doing a webinar, and you're welcome. Anybody who's listening, you can send me an email at aj@tradingtrainer.com. The webinar, I'm going to give 9 different ways to make sure to test that you're seeing a pattern of sideways choppiness, and then 5 different ways that you could trade it. And that's this Thursday. The other way, you can either aj@tradingtrainer.com, or you can just go to thursdayevent.tradingtrainer.com. That's a web address. It's a free webinar.
Yeah, as I was sitting on my hands, I was thinking, those damn option guys are loving this.
You betcha. Well, my head coach and I have been like just comparing notes. He's like, "What are you doing?" I said, "Well, I got a couple of straddles and strangles sitting there in the sidelines waiting for a break, but in the meantime, I've got calendar spreads that are kicking butt right now with the low volatility that's inching higher."
Yeah, and then, you know, the other thing that happened in that range is that it was kind of a weird thing. If you look at like the day-to-day ranges, you had volatility within the range. It was like I knew you option guys were having a blast doing that. But hey, stick to what you do best. You know, we have a saying in the South: the sun doesn't shine on the same dog's ass every day. So if it takes us for a long time, I know that eventually a trend is going to develop, and I'll get to ride that trend.
Absolutely.
Okay, Glenn. Yeah. Okay, Glenn, let's go over to you. Glenn Thompson of PacificTradingAcademy.com. Anything else you want to tell us about yourself, the markets, your trading, or PacificTradingAcademy.com?
Sure, and I kind of echo a lot of what AJ and what you and Bennett have all been saying. So that, you know, I appreciate the forum. I've been one over the years who kind of likes to stay in the proverbial closet. And now I got to that once I felt I knew enough to be comfortable in my own conclusions that I came up with. I say that to say, but there are exceptions, and this type of forum is one of them, to be privy to an interchange of ideas. You know, you want to. We are in an information business. Um, 24 to, and I know AJ is trading options. I hated options the very first time I became aware they were introduced to me, and I've done a complete 180 in terms of that. I love it. So selling volatility during those periods of congestion, or if there is no activity, create volatility by virtue of certain option spreads you can create and set up. But so I'm appreciative of all of these types of strategies. One point, if I may, Dave, to your point, I think I heard you mention earlier that maybe one of the constructive critiques that maybe some of the viewers and listeners to these meetings have offered is that we tend to be too uniformly in agreement one with another. So here's at the risk of being hopefully not too provocative, on a specific situation, I think I heard you say you think that oil in particular may have bottomed out. I technically, my Elliott count, my Fibonacci level, all the structural, or most of the structural components from a technical view that I am looking at would tend to agree with you. And I usually go with that, my technical assessment. However, I am short oil, and I have been for the last 2.5 months now. If I look at the structure, I think we're in a little micro fourth wave, after which I expect a blast out to higher prices, the formation of a fifth. I think the bottom that came in, the previous bottom a few weeks ago, I saw a confluence of embedded or nested fifth waves, one within another, and I think Elliott in his original paper said, you got that, 97% probability you've reached a terminal point in market. So most of the technicals I'm looking at suggest we are at a bottom. But I am concerned, me being a technician, giving some weight and credence to the confluence of fundamentals. My concern is this, and this is where it may create a difference and why I'm short. In the big macro picture of all the fundamentals, given the amount of global debt, to what extent are the oil-producing nations going to need to or be compelled to just pump more? And put off cutting production, and that's why I'm bearish. I'm wondering, and if I think about it, and I think Bennett mentioned, look at the long term, the weekly, monthly, quarterly charts. What's that long-term trend still? Yeah, in the last month or so, yeah, in other words, when we hit that bottom, is everything from that bottom a few weeks ago through where we are right today, is that marking the beginning of a new bull, or is it a correction in a rally in a bear? Normally, if I were to trust my technicals solely, I would be long. I just got to wonder, weighing that against that big macro picture, the burgeoning, mounting debt worldwide, and a convenient and easy way to service it is to pump more hydrocarbon fuel out of the ground. And I'm wondering if that another leg down in oil prices. That's my only concern.
I hear you on that. As a trend follower, I have longer-term trend patterns, which I call trend resumption, where you have a solid trend, and then you look to play pullbacks along the way. I do have what I call some emerging trend patterns, such as the aforementioned bow tie, and another one is what I call a first thrust. You get a big rally off of a major low or multi-year low, whatever the case may be, and ideally an all-time low. Like sometimes at Forex, you'll get one off all-time high, all-time low. And when you see these patterns, sometimes every bottom and every major top will have one of these patterns, but every one of these patterns won't be a major top or bottom. And the thing is, like in oil, and we're long USO right now, and we're underwater. We're losing money on the position so far. The longer-term trend is down. The shorter-term trend, at least a couple of weeks ago, we had the thrust off of lows, and it's a pattern I call a pioneer first thrust. And like the pioneers, you're either going to get the arrows in your back or you're going to get the gold. So I think when you're down at these low levels and you get the big rally off of lows and you get the setup and then you get the entry, it's worth a stab at the market, because if you do catch, and I'm anti trying to catch a bottom, but if you do have signs of the bottom maybe put in, such as oil so far at least, then your risk to reward is very high. If it goes back to old lows, it's a no-brainer. As a trend follower, you have to get out. And we did a recent YouTube video on this, and we talked about it quite a bit. That's the beauty of these transitional patterns, these emerging trend patterns. If you're trading a longer-term trend, let's say you're trading a pullback, and you get into the market, and the market keeps pulling back, pulling back, pulling back. You're not sure where exactly you should stop yourself out, and so at some point you stop yourself out, and then the trend continues. If you're trading an emerging trend pattern, you know if it goes to new lows, you're absolutely wrong, and you have to get out of the way. So, yeah, I hear you on that, and I will agree. Well, geez, we need controversy, though. Damn it, no, it's a bottom. No, I will agree. Longer-term trend might still be down, but I'm looking for a turn there. Okay, Bennett, let's go over to you. Any closing thoughts about the market, about yourself, about trading in general, and anything else you want to tell us about TradersCoach.com?
Well, I thought today was great. I thought everybody had a really great perspective and very knowledgeable, so I think that's terrific.
Thank you.
On oil, I'll say something even a little different. On oil, from an Elliott wave count, on the daily charts, we believe a 3 just finished, and we're going into a 4. And we could see a rally up to 25 to 30. This is on the ETF I'm looking at right now. So, and then more selling as an Elliott wave 5 comes in. So I don't think a bottom's quite in yet, but I do think we're going to see a little bit of a rally here that may last into the summer some point, but then some more selling. Overall, like you said, Dave, it's consistency that counts. Market moves in cycles. Every dog has its day.
Yeah.
I kind of gave up the bragging a long time ago because, you end up with a little mud on your face in the next cycle. I think really the important thing to do, and what really helped my trading, was to always talk in terms of probabilities. And then you will always protect your downside. I think the risk control is really, if you want to talk about a holy grail, one of the key components of being successful. In my trading, I do really well if I win about 60 to 63% of the time. That's it. Yeah. All right. Yeah. So I'm wrong 4 out of 10 trades. But the key is to cut those losses and keep your trade size or position size such that your losses can be kept at a consistent percentage, and we shoot for around 2%. So if you're losing 4 trades out of 10, you're going to lose around 8, maybe 10% if you get a bad fill. But you're going to make a lot more than that because one of those 6 trades is going to be a big one. Usually, is what happens. Yeah. So that's how you make money. But you have to protect your downside and not get mad if you have 3 or 4 stop outs in a row. Yeah. The other thing I'm good for every year is 1 or 2 mental mistakes, especially when it comes to order fills and things like that. I made a really bad one, cost me over 100% on a small cap stock. It was stupid. The stock had already made me 100%, thinly traded, so I put a limit stop instead of a stop market order in. Yeah. And it never got filled, so I ended up that trade with a 6% return instead of 100. Okay, yeah. Because it was stupid. I mean, if you think about it from a common sense approach, even if it was a bad fill, I probably would have gotten 80%. Yeah. So things like that prop up every once in a while for all of us, and you have to take that into account and learn from it. That's all. The key is to always consistently learn.
Yeah, and that's key. There's going to be some mistakes. There's going to be some mistakes like that. So you have to make hay when the sun shines. You got to make as much as you can because the things will come along. You kind of brought up something interesting. It's amazing how many people would rather be correct than make money. Our egos get in the way, or their egos get in the way, I should say. And you pointed out that the mud on your face, etc. It's like, if you haven't had your ass handed to you, I hate to be, PG-13 here, you probably haven't been trading long enough, and you haven't learned to respect money management. I have a friend of mine, Joe Corona, and he used to travel the world when he was a little bit younger looking for volatility, and he found that volatility once in India, and he was telling me exactly that. He says, Dave, the new guys that haven't had their butt handed to them, they have no respect for money management, and then 6 months down the road, it just knocks them out or whatever. And he says they come into my office almost in tears or whatever. I don't want to embellish too much, but I kind of imagine how it would go down. And then at that point, he's like, congratulations, you just learned your lesson. Now go back out there and do the right thing. As far as DaveLandry.com, I have a lot of educational material there. I do a weekly webinar in addition to this one with David Kosmitter, and you can sign up on my website. There's a countdown there on my website. If you want to come to these shows, if you're watching the YouTube of this now, sign up on my show for future shows for Timing Research. .com. And anything I mentioned here, I don't have any proprietary indicators, so everything I do is fully disclosed. So if I mention a pattern or something that you're interested in, shoot me an email. And I think that's about it. My email is david@davelandry.com. Once again, I want to thank everybody for coming today, and I think David will wrap things up. Thanks again to you, David, too.
Okay. Thanks, guys. I just want to remind everyone who's watching to go to TimingResearch.com/reports, and you can download the most recent report and all the past reports there if you haven't had a chance to look at those yet. Also, be sure to go to TimingResearch.com/current survey next week, sometime before Sunday afternoon, or this coming weekend, sometime before Sunday afternoon, to fill out this week's survey. And just want to thank all my guests. AJ Brown of TradingTrainer.com. Thanks for being here for the first time.
Thank you.
Bennett McDowell of TradersCoach.com and Glenn Thompson of PacificTradingAcademy.com. Thanks for being here again. And of course, Dave Landry of DaveLandry.com. Thanks for hosting.
Thanks for having me back again, David. Appreciate it.
Thank you, David.
Thanks, everyone.
Thank you, Dave. Dave.
Dave, both you guys. Yeah.
David squared.
David squared.
Thanks, guys.
Okay.
All right, thank you.
Bye.